David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Seth Edgil are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by Seth Edgil, a financial advisor with Keystone Financial Group here in Trussville, to discuss the latest in economic and market trends. Seth, thanks so much for being with us today. In our last conversation, we touched briefly on the state of markets and the threat of a recession. We talked about artificial intelligence's influence on markets. Have the threats of a recession lifted? Are we still seeing AI have huge influences on markets?
I want to expand on that topic a bit before I attempt to answer those questions. Markets seem to be heavily bifurcated. According to Yahoo Finance, we have 8 mega-cap stocks that are worth over $11 trillion combined. The other 492 companies in the S&P 500 are worth $27.6 trillion, according to the market research firm Yardeni Research. We have seen these companies outperform the rest of the market by a great margin this year. In fact, these 8 technology stocks have caused the NASDAQ to have the best first half of a year since 1983, according to CNBC. That is a staggering figure given that time period includes many big events in the tech world. The recovery in the NASDAQ has outpaced the dot-com bubble, the adoption of e-commerce, even the meteoric rise of these mega caps such as Apple and Google. The rate of the growth is indicative that investors do not want to miss out on broad adoption of artificial intelligence technology. Using an example from history, in the dot-com bubble, we saw a similar rate of growth in the NASDAQ. After the dot-com bubble burst, it took the NASDAQ over a decade to recover those losses. Although the past performance is not necessarily indicative of future results, investors need to be aware of these past events. When we have 8 companies pulling the NASDAQ up at the fastest pace in 40 years, following a year of negative performance in the NASDAQ, then a correction back to normal levels could be devastating for investors. This could especially hurt investors in passively managed ETFs, as they might be unaware that their S&P 500 ETF has a large concentration in 8 companies. All investing involves risk. My fear is investors aren't aware of all the risks they are taking.
Well, it seems like we are still seeing similar market conditions. Am I correct in assuming that a threat of a recession could still be looming?
In my opinion, a recession could definitely still happen. Every day we avoid a recession, we get closer to the Federal Reserve's soft landing. The issue with a soft landing is that in its nearly 110-year history, the Federal Reserve has been unable to achieve a soft landing when implementing an economically tightening strategy. Another troubling sign to me is that Fitch, a big 3 credit rating agency, downgraded the quality of U.S. Treasuries on August 1st. This is the second time in history a big 3 firm has downgraded U.S. debt quality. An argument can be made that the United States' ability to always pay its financial obligation is a cornerstone in the stability of the U.S. dollar and the U.S. financial sector as a whole. Fitch cited the recent debt ceiling crisis, fiscal irresponsibility by Congress, and a lack of collaboration between the political parties as reasons why the U.S. may be unable to pay its bills in the future. Another metric I'm watching closely is disposable income and wage growth. The Federal Reserve has been aggressively attacking inflation since the spring of 2022 through monetary policy. We are finally seeing the consumer price index go lower than wage growth, meaning wages are adding to purchasing power to workers. However, according to the DOL, wages have been growing at a declining rate for a considerable amount of time. This tells me that it's going to take time for consumers to feel more confident about consumption. It's a common theme in the media to talk about the resiliency of the American consumer, implying that Americans are continuing to consume in spite of inflation draining their buying power. This thought process seems to ignore the fact that credit card debt in the U.S. topped $1 trillion earlier this month, according to Forbes. LendingTree says that credit cards are charging an average of 24.37% interest, which is the highest rate that firm has recorded since beginning to track that metric. I would argue that the resiliency of the American consumer lies within our historically high credit card balance. Going forward, it will take a greater percentage of consumers' budget to service that debt, since interest rates on that debt are extremely high. In addition to servicing credit card debt, student loan payments will resume on September 1st. Couple these two facts with the fact that the majority of Americans are living paycheck to paycheck, and there's a case to be made that we have not yet defeated the probability of a recession.
Are the interest rates expected to continue to rise, causing even more strain on consumers' budgets?
While it is impossible to predict interest rates with certainty, the data suggests interest rates will at the very least not decrease anytime soon. The Federal Reserve remains dedicated to their fight against inflation. They are expected to raise the Fed funds rate at least once more this year. Also, they are expected to continue to drain lendable reserves out of the M2 money supply. Both these actions push interest rates higher across the board. It is certainly a fear of mine that corporate revenues will decrease because consumers will no longer be able to be resilient as they have to pay money back that they borrowed. Always, I recommend consulting with a fiduciary to understand the risk you are taking in both your retirement accounts as well as your entire financial footprint. A plan is only as solid as the risk it can avoid. Some investors, for example, need to prioritize return and take additional risk. Every person has a unique set of circumstances that give them a need to receive advice that is customized to them. If anyone has a need for consultation, they can reach out to our firm for advice.
Well, thank you, Seth, for the insight and market outlooks. We rehashed a lot of the same information from last month, but reiterating old information with the new data you presented gives us new insight on the state of the economy. And for additional information, Seth may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brannon Dawkins.
David Guttery and Seth Edgil independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.